Look, if you've ever opened up your 401k menu or Roth IRA menu and you felt like you needed a translator, you're not dumb. That stuff is confusing on purpose, but I'm going to show you the one option that's in almost every retirement plan for a reason. And that option is the S&P 500. Because here's the truth, most smart investors don't try and pick winners. They just buy the S&P 500 and they buy it consistently and they let time do the heavy lifting. I personally do this myself. I do have other options and stuff that I choose, but the S&P 500 is huge. And if you understand this one concept, you're already ahead of most people. Quick disclaimer, I'm not a financial advisor. This is for educational purposes only. Do your own research before investing. I'm just talking about what I do and things I've learned along the way. What's up, y'all? I'm Eric. This is Money Moves with Eric. Welcome to my new channel. If you're trying to build real wealth, retire early, and stop guessing with your money, you're in the right spot. Welcome to this video. Hit the subscribe button if you guys want to talk about simple real world investing breakdowns, none of the Wall Street nonsense, just average people talking about their investing journey and journey to financial freedom. Now let's talk about what the S&P 500 actually is in plain English to make it easily understandable. So the S&P 500 is basically a team roster of 500 of the biggest public companies in the United States. Think about companies like Apple, Microsoft, Amazon, Google, Nvidia. They're the companies that you probably use every single day. So when people say the market was up today, they're usually talking about the S&P 500. It's all those major companies right there. And when you buy an S&P 500 index fund, you're buying a tiny piece of all 500 companies at once. It's not just one stock, it's not a guess, it's not a gamble. You are just owning America's biggest businesses. That's huge. And this isn't random. It's for purpose. And to get into the S&P 500, a company has to meet certain standards. And so some of those standards are it's got to be US based, it's got to have large market value like multi-billions, it's got to have real trading volume, and typically it's profitable and financially stable. So you're not buying some like brand new hype company that could disappear overnight and lose all of your money or anything like that. You are buying companies that have already proved that they can compete, survive, and grow. And yeah, it's 500 companies, but the real question is, are they all equal? Here's the part that most people don't know. They hear 500 companies, they think it's an equal slice of all 500, and that's not the case. The S&P 500 is weighted, and it's weighted for a reason. What's that mean? The biggest companies matter the most. So if, say for instance, Apple and Microsoft move, the S&P 500 moves. That's why people say stuff like the top 10 stocks are a big piece of the market, or you'll hear people talking about the Magnificent Seven. Is that bad? Not necessarily. And that's because those companies, they're big for a reason, right? They've got massive revenue, they've got massive profit, they've got global dominance. And does that mean the S&P 500 leans heavily towards like large cap mega companies? Okay, well, here's why most investors use it. Like the real reason why most investors use the S&P 500. And it's really not that complicated. It's because it's historically been extremely hard to beat the S&P 500 long term. Now, most people think surely the pros can beat it, but in reality, like honestly, most professionals don't. They'll go hire someone to manage their portfolio and all this and all that, and a lot of times they underperform the S&P 500. Why? Because of the fees, because of like the market moving so fast and things like that. The S&P 500 is just consistent, and it's consistent over time. And by the time the news hits your phone, like your price is already adjusted on all the other stuff that you've bought. So like for a lot of people, the best move isn't trying to outsmart the market. It's owning the market, owning the S&P 500. And you're doing it with low fees, and because fees they're a silent killer of like your whole portfolio. Like you don't want a bunch of fees and stuff. So paying 1 to 2% interest a year doesn't sound like much until your account grows and that fee becomes thousands and thousands of dollars every year. Now, index funds are often fractions of a percent. I mean, like they are small fractions of a percent. That difference over 20 to 30 years can be life changing. And the returns plus the compounding and like why this works, let's break it down. Historically, the S&P 500 has averaged around 10% per year. That's over long periods. Now, that's not saying that that happens every year. That's the average of each year. Now, some years it's up huge. Some years it's down bad. Like we've all seen the times that it's down bad. But over time, it trends upwards because businesses grow. So, yes, it goes up and down, but when you zoom out large scale, it's always trending upward. And compounding is what turns the small contributions into like holy crap money. Like you put money in, it's going to grow, and then the growth is going to grow. That's the game. That's the investing game, especially for like basic investors like you and me. But of course, there's things that we worry about too. Like, what about market crashes, right? Let's talk about that scary part. The market drops just like it did last week because, yeah, it's going to drop. History is going to repeat itself. There's going to be bad economic times. That doesn't mean it's a bad thing, but when it does, majority of people are going to panic and then they're going to quit. But a long-term investor, especially one like me, like I'm planning to be in it for 30, 40, 50 years. Here's something that we understand. A market crash is basically a sale. That's how I look at it. You're investing monthly and you're buying shares cheaper. You're getting quality companies at a discounted price. And when the market eventually recovers, which it's going to, like it always has historically, those cheaper shares are going to be your best buys. And the people who win aren't the people who time it perfectly because, like, let's be real, that's never going to work out. You're not going to time the market perfectly. It's the people who stay consistent while everyone else is emotional. The boring wins, right? Like, that's what I talk about on this channel and stuff. Like, building wealth is boring if you're doing it correctly. And so, yeah, the S&P 500 is boring. It's like that way for a reason, but boring builds wealth. The flashy stuff sells courses, the simple stuff like actually builds millionaires and it builds them over long periods of time. And if you want the easiest like set it and forget it foundation for investing, look no further. That's the S&P 500 right there for you. That's why so many people start with the S&P 500. That's exactly how I started before I started adding a couple other little things here and there. But if you want, comment S&P. I'll reply with like a simple starter setup for like Roth IRA versus brokerage or S&P 500 like fund examples or basic allocation for beginners who might just be starting this out for the very first time. Or if you're building your own road to $1 million like I am, subscribe because I'm posting real numbers, real strategies, my real progress. I'm showing you guys the entire process along the way, starting from like that $100,000 mark all the way until we reach $1 million mark. I'm going to show you the wins. I'm going to show you the losses. I'm going to show you the up days, the down days, and everything in between.